Hello, everyone, and welcome to another episode of Edelweiss Money Connect podcast. Here you can learn interesting investment nuggets gathered from specially curated book summaries featured in our Edelweiss Insights book summary. You can read our book summaries and listen to our Money Connect podcasts on the Edelweiss Mutual Fund website, Spotify, and Google Podcasts. So simply grab a coffee, sit back, and enjoy today's inspiration. So, Neha, tell me, what is the first question that comes to your mind when you evaluate an investment?
That's easy, Vineet. I usually ask, Kitna milega? After all, the whole purpose of investing is to generate returns.
True, Neha. However, an equally important question to ask is, Kitna risk hai? If you really want to become a successful investor, you must focus on the downside risk first, and then evaluate the returns that you can potentially make.
That's very interesting, Vineet.
Yes, it is. In today's podcast, we will be learning on how to make the best investment decisions by reducing the downside risk through Seth Klarman's book, Margin of Safety. The book discusses the importance of value investing and lays out guidelines on how to become a great value investor by reducing downside risk.
The root of the problem is in the question, Kitna milega? When investors only focus on how much money they can make, they get lured by the prospect of quick and easy gains. This is when they start investing in fads and trends and pay little attention to the underlying risk.
On the other hand, by actively trying to avoid loss, you're most likely to generate a profitable outcome. Thus, it is always better to earn consistently good returns with limited downside risk, rather than to generate occasionally high and volatile returns.
Stock prices tend to move up and down due to two reasons. One, to reflect how people think a business is going to perform, and two, to reflect short-term variations in supply and demand. Thus, the actual downside risk cannot be determined from historical data. Rather, it depends on the price you pay to purchase the security.
This brings us to the concept of margin of safety. This represents the cushion that you have in case stock prices fall and is basically the difference between the actual value of a stock and the price you pay for it.
The higher the margin of safety, the better it will be for your investment portfolio.
Now, let's see how we can analyze a stock to arrive at its true value. The first is an analysis of going concern value, known as the net present value or NPV analysis. Basically, when you want to calculate the NPV of a business, you estimate all the money and cash flows that it is going to get over the next few years. Then, you take a commonly used discount rate to find the present value or today's values of those cash flows. If the per share NPV is much higher than the stock price, then it could be a good business to buy. On the other hand, if the NPV is lower than the stock price, then you should not buy it. The second method of business valuation analyzes the liquidation value. This means that you would value the company based on the value of its assets. Assume that you sell all the assets of the company and get a certain amount for it. If the per share value of these assets is higher than the stock price, then you should consider buying it. And if it is lower, then you should probably avoid it. The third method of valuation is stock market value. This is an estimate of the price at which the company or its subsidiaries considered separately would trade in the stock market. Less reliable than the other two, this method is only occasionally used to value a company.
I think it is clear that if you are a value investor, then you are probably a contrarian investor as well. This is because when everybody is rushing to buy a security, then its price will definitely increase. Once the price increases, it might be higher than its true value. On the other hand, securities that are ignored by most people tend to have a lower price. Thus, the chances of these securities trading at a discount to their value are much higher.
It is important to remember that the presence of a catalyst can help you reduce risk. A catalyst can be a news or a development that can suddenly cause a price increase. Generally, a value investor looks to buy a security where there is a large enough difference between the price and the actual value. The idea is that the price will eventually increase and reflect the true value of the security. So finding a security where this difference between the price and the value reduces quickly can be profitable.
Another factor that can help you reduce risk is diversification. However, this is a tricky one since the number of diverse investments that you own will dictate the level of diversification that you can achieve. According to Seth Klarman, as few as 10 to 15 holdings should be sufficient.
And to finally round up, don't just focus on the price that you pay to buy an investment. Also, focus on the price at which you sell it. There is only one valid rule for selling. All investments are for sale at the right price. Decisions to sell, just like decisions to buy, must be based upon underlying business value.
To summarize the key takeaways from this book, risk is equally, if not more important, than return. Thus, when you are in the process of making an investment decision, first check how much money you can lose and then evaluate how much money you can make. Margin of safety is a great way to reduce downside risk. It entails buying securities that are trading at a deep discount to their market price. Generally, the wider the margin of safety, the lower will be the downside risk. To determine the margin of safety, you first need to calculate the intrinsic value of a security. There are several methods to do this, namely NPV method, liquidation value method, and stock market value method. Value investors are also generally contrarian investors. This is because the securities that the herd buys are usually already either well priced or even overpriced. Thus, there is little value to be found there. Diversification is key to reducing overall portfolio risk. The sell price matters as much as the buy price.
The thing is, Neha, since value investing entails studying a company, it might not always be possible for investors to do the relevant NPV or other analysis. Thus, investors might be better off investing in mutual funds.
That's right, Vineet. Basically, mutual funds are investment vehicles that are managed by expert fund managers. They pool investor money and then invest it in different asset classes like equity, debt, gold, etc. Within equity investing, certain mutual fund schemes follow the value investing approach, wherein the fund manager along with the investment team uses the value investing methodology to identify stocks that are trading at the deep discount to their market price and thus have a good margin of safety.
An additional benefit of investing through mutual funds is that they also give you an opportunity to diversify your portfolio, thereby reducing overall portfolio risk. From that perspective, they can help you become value investors without having to make the effort to analyze a stock, determine the buy price, and track it till you reach the best sell price. You can listen to more such interesting book summaries on our Money Konnect podcasts. These are available on the Edelweiss Mutual Fund website, Spotify, and Google Podcasts for you to listen, learn, and enjoy as per your convenience. For further information on one-time KYC process, list of SEBI-registered mutual funds, and redressal complaints, visit our website. An investor education and awareness initiative of Edelweiss Mutual Fund.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully